Imagine this, you've got £100,000 or even just £10,000. You could leave it in the bank, watch inflation eat away at it and earn a few pennies in interest, or you could put it to work in the stock market. But where do you put it without spending hours staring at stock charts? Today, I'm breaking down 5 of the most popular ETFs that you can buy right now on Trading 212. I'll show you how they've performed, what makes each one unique, and exactly how much your £100,000 could grow over the next 10, 20, and even 30 years. And wait until you see one of these ETFs that could skyrocket your returns from £100,000 to £24 million. Let's get into it. The first is Vanguard S&P 500 ETF, VUSA or VUAG. This is Trading 212's most popular ETF, and for good reason. It tracks the S&P 500, the 500 largest companies in the US. You're getting Nvidia, Apple, Microsoft, Amazon, Tesla, and hundreds more in one simple trade. Nearly 60% of the portfolio sits in technology, financials, and consumer discretionary stocks. VUSA pays dividends directly to you, currently around 1%, paid quarterly. VUAG reinvests those dividends automatically, compounding inside the fund. It's also one of the cheapest ETFs out there with an expense ratio of just 0.07%. VUAG was only launched in May 2019, so it doesn't have a 10-year track record. So we use its 5-year total return of 96.14% or approximately 14.4% per year. What does that mean for your £100,000? If history repeated, after 10 years, you'll have around £385,000. After 20 years, roughly £1.48 million. And after 30 years, around £5.7 million. Of course, past performance doesn't guarantee future returns, but it just shows how powerful the S&P 500 has been over time. Next is Vanguard FTSE All World ETF, VWRP. This ETF is the definition of diversification. With one trade, you're investing in 3,624 companies across nearly 50 countries. Yes, it's still tilted heavily towards the US. Around 66% is in North America, but you also get exposure to Europe, Asia, emerging markets, and the Pacific. Like VUSA, nearly 60% of the portfolio is in technology, financials, and consumer discretionary. It has an expense ratio of 0.22%, and the distributing version, VWRL, pays around 1.49% dividend yield quarterly. VWRP hasn't been around long enough for a 10-year track record. It was launched in July 2019, so we'll use its 5-year total return of 76.2%, or approximately 12% per year. What happens with £100,000 invested? After 10 years, you have around £310,000. After 20 years, around £964,000. And after 30 years, close to £3 million. This is the ultimate set and forget ETF. You're not betting on a single country, you're literally buying the global economy. The third most popular ETF is iShares Physical Gold ETF, SGLN. Gold isn't about growth, it's about protection. SGLN is physically backed by gold bars stored in London vaults, not synthetic derivatives. While gold doesn't guarantee gains in a crash, it usually falls less than stocks and recovers faster. In 2008, while global markets dropped over 30%, gold finished the year positive. It has an expense ratio of 0.12%, but it doesn't pay any dividends. It's a hedge, not an income asset. Performance over the past 10 years has averaged 11.49% annually. So let's run £100,000 through the maths. After 10 years, you'd have around £296,000. After 20 years, about £880,000. And after 30 years, about £2.6 million. Gold's role isn't to deliver explosive returns, it's to balance out the risk of everything else in your portfolio. The next is Vanguard FTSE Emerging Markets ETF, VFEG. VFEG gives you access to 2,273 stocks across developing economies. It has an expense ratio of 0.22%. The portfolio is dominated by China, Taiwan, and India, which together make up 74.5% of the fund. The income version, VFEM, pays around 2.5% in dividends quarterly. This fund was launched in September 2019, so it doesn't yet have a 10-year performance record. Over the past 5 years, it's returned 32.52% total, or around 5.8% annualized. So what would £100,000 look like? After 10 years, you'd have around £176,000. pounds. After 20 years, about 308,000 pounds. And after 30 years, around 542,000 pounds. Emerging markets are volatile. You can see incredible growth in some decades and very little in others. But long term, this is where much of the world's population growth, rising middle class, and economic expansion is expected to come from. And finally, the growth powerhouse. iShares S&P 500 Information Technology ETF IITU. IITU is pure tech. Nvidia, Apple, Microsoft, and dozens of others driving AI, cloud computing, and semiconductors. Out of its 69 holdings, 60% of the fund is concentrated in just those top 3 names. Risky, yes, but that's also why returns have been explosive. It has an expense ratio of 0.15%. IITU hasn't been around for 10 years. It was launched in November 2015. Over the past 5 years, it's returned 19.92% annualized. That's the figure we use here. Let's run the numbers on 100,000 pounds. After 10 years, at 19.9%, you'd have around 615,000 pounds. After 20 years, around 3.86 million pounds. And after 30 years, a staggering 23.3 million pounds. This is the ETF with the most potential. Of course, tech can crash hard, but over decades, it's been the engine of market growth. There you have it, 5 ETFs you can buy right now on Trading 212. Each of these ETFs has the potential to deliver life-changing returns, even without factoring in the dividends received along the way. The question is, how would you split your 100,000 pounds across these ETFs? If you're younger, tilting towards growth may be the optimal strategy. As you get older, preserving wealth becomes more important. Let me know your thoughts in the comments below. And if you don't have 100,000 pounds sitting around, don't worry. Investing about 1,500 pounds a month could get you to a similar place over 30 years. I know that's a lot, but even if you can't, there are other ways to build wealth. Click this playlist for dividend strategies to fast track your journey to financial freedom. Thank you so much for watching, and I'll see you in the next one.